gold explodes on the screen without warning. 100 pips in minutes. Green candles stacking on top of each other like a fire spreading through dry grass. A trader watches it happen, hands frozen over the keyboard, heart pounding. He didn't take the trade. He wasn't ready. He wasn't sure. And now it's too late. Bitcoin does the same thing an hour later, ripping upward on some headline he hasn't even read yet. He can't take it anymore. He clicks buy. No confirmation. No setup. Just the raw, physical need to be part of whatever this is. 5 minutes later, the candle reverses hard, and the money he was so afraid of missing out on is now the money he actually lost. This is the moment we need to talk about tonight, because what just happened to him isn't weakness. It isn't stupidity. It's one of the oldest survival mechanisms in the human brain, hijacked completely by a market that was never designed to be survived using instinct. Tonight we're going to understand exactly why FOMO destroys more trading accounts than bad strategies ever could, and why almost nobody sees it happening until the damage is already done. Let's start with what FOMO actually is, because most traders think they understand it and almost none of them actually do. FOMO isn't just excitement. It isn't just impatience. It's the fear that somewhere, right now, other people are winning and you are being left behind. That fear feels exactly like opportunity in the moment, which is precisely why it's so dangerous. Real opportunity comes from your own analysis, your own setup, your own criteria, being met on your own terms. FOMO comes from watching someone else's success and feeling an urgent physical need to catch up to it. Beginners constantly confuse the two, because both feelings show up as a rush of energy telling you to act right now. But opportunity waits for you to be ready. FOMO doesn't wait for anything. It just needs you to move. Patience looks like doing nothing, while everyone else seems to be doing something. Impulse looks like doing something just so you don't feel like you're doing nothing. Learning to tell these apart in the moment, not after the trade, is one of the quiet skills that separates traders who last from traders who don't. Now, let's go deeper into the psychology behind this, because understanding the mechanism is the only way to actually disarm it. Loss aversion is one of the biggest drivers here. Human beings feel the pain of losing something roughly twice as intensely as the pleasure of gaining the same thing. So when you watch a trade moving without you, your brain doesn't just register it as a missed gain. It registers it as an actual loss, something that was almost yours and is now gone, even though you never had it in the first place. That distorted math is what makes watching a candle run without you feel unbearable. Social proof adds fuel to this fire. When you see other people posting screenshots of green trades, celebrating in trading groups, or hyping a coin on social media, your brain assumes that if everyone else believes this is right, it probably is. This is a survival instinct from thousands of years of group living, where following the crowd usually kept you alive. In trading, following the crowd usually gets you in exactly at the moment the smart money is already getting out. Recency bias convinces you that whatever just happened will keep happening. If gold just ripped up 200 pips, your brain assumes it will keep ripping, ignoring the fact that markets move in cycles, not straight lines. The scarcity effect makes it worse, whispering that this specific opportunity, this exact candle, this exact coin pump will never come again, so you'd better act now before it disappears forever. And underneath all of it is dopamine, the same chemical that fires when you see a slot machine light up. Released the moment you imagine the profit you could be making. Right. Now, if only you'd clicked a few seconds earlier. Have you ever watched a candle rip upward and felt an almost physical pull toward your mouse? even before you'd checked a single thing on your checklist? Be honest with yourself. Most traders have felt exactly that pull more times than they'd like to admit. Let's talk about why traders chase candles in the first place, because this rarely starts with the chart. It usually starts somewhere else entirely. Late entries happen because the trader waited for confirmation that never came, then panicked and jumped in anyway once the move was already mostly over. Buying tops and selling bottoms happens because the emotional peak of a move, the moment it feels most exciting, is almost always the moment it's closest to reversing. Watching other people's profits on social media creates a constant, low-level anxiety that you're falling behind, even on days when staying out of the market was actually the correct decision. Telegram signal groups and Discord communities amplify this further, creating a shared emotional current where hundreds of people feel the same urgency at the same moment, which is exactly the kind of crowd behavior that precedes a reversal. Psychologists call this emotional contagion. Human beings naturally absorb the emotions of the people around them, almost like catching a cold. In trading, excitement spreads just as quickly as panic does, moving through a group chat in seconds. You weren't chasing the chart. You were chasing everyone else's emotions, mistaking their adrenaline for your own analysis. Trading influencers posting oversized wins, real or exaggerated, create a distorted picture of what normal trading actually looks like. Your brain remembers the trader who turned a small account into six figures because that story gets shared, screenshotted, and repeated everywhere. It quietly forgets the thousands of people who tried the exact same reckless approach and lost everything because those stories never get posted. This is called the availability heuristic. We judge how common something is by how easily we can recall an example of it, not by what actually happens most often. One viral success story can feel like proof that huge, fast gains are normal, when the far more common outcome, the quiet account blown in silence, simply never makes it into your feed. Traders can't wait because waiting requires tolerating uncertainty, and the human brain is fundamentally uncomfortable with uncertainty. Action feels like control, even when that action is the exact opposite of control. Let's go back inside the brain for a moment, because this isn't just a bad habit. It's biology working exactly as it was designed to, just in the wrong environment. The prefrontal cortex is your rational mind, the part that can look at a setup and calmly decide it doesn't meet your criteria. The emotional brain is older and faster, built for immediate threat and immediate reward, and it does not wait for permission from the rational mind before reacting. When you see a huge green candle, your emotional brain doesn't interpret it as market data. It interprets it as an opportunity slipping away, which triggers something close to a fight or flight response, flooding your body with stress hormones as if you were in actual physical danger. This is why your hands can genuinely shake before an impulsive trade. Your body believes it's protecting you. Decision fatigue makes this worse. If you've already made dozens of small decisions earlier in the day, your ability to pause and think clearly in this moment is already depleted, leaving the emotional brain with much less resistance than usual. And your reward system, the same one involved in every addictive behavior, has already started anticipating the dopamine hit of a winning trade before you've even clicked the button, making the click itself feel almost inevitable. Now let's look at how FOMO actually destroys accounts, because it's rarely just one bad trade. It's a chain reaction. A late entry, taken purely out of urgency, immediately puts the trader in a worse risk position than a properly timed entry would have. That discomfort leads to breaking rules because the trader convinces themselves this particular trade is the exception. Breaking one rule makes overtrading easier because the emotional dam has already broken, and taking a second impulsive trade now feels less significant than it should. Oversized positions creep in next because the trader wants to make up for the bad entry quickly, doubling risk without doubling their analysis. Stop losses get ignored or moved because admitting the trade was wrong feels worse than hoping it turns around. And when it doesn't turn around, revenge trading begins, an attempt to win back losses immediately, driven entirely by emotion rather than any real setup. One emotional decision doesn't just cause one loss. It opens the door for the next 5 decisions to be emotional too. Here's how professional traders actually think differently, and it's simpler than most people expect. Professionals miss trades constantly, and they're genuinely fine with it, because they understand something beginners don't. There will always be another opportunity. The market that exists today will still exist tomorrow, next week, next year. No single candle is the last chance you'll ever get. This single belief changes everything about how a trader behaves in real time. If there's no valid setup, there's no trade, regardless of how the chart looks or how much noise is happening around it. Professionals treat process as the goal, not excitement. A calm, boring, well-executed missed opportunity is a win in their mental scoreboard, even though it produces $0 because it protects the only thing that actually matters long-term, their capital and their consistency. A trader watches Bitcoin spike after a headline hits his feed. Everyone in his group chat is posting profits within minutes. He convinces himself this is different, that ignoring it would be foolish. He enters late with a full-sized position. No plan, no stop-loss set in advance. The coin pulls back sharply the moment he enters, and he watches half the move evaporate in the same amount of time it took him to open the trade. The lesson is simple. The excitement you feel watching other people win is not the same thing as a setup. A trader is watching gold consolidate quietly for an hour. Nothing is happening, and the boredom becomes almost unbearable. He starts imagining a breakout that hasn't actually occurred yet, and enters a long position based purely on the feeling that something has to happen soon. Price breaks the opposite direction 10 minutes later, stopping him out instantly. The lesson here is that boredom is not a signal. It's just boredom, and the market has no obligation to entertain you. A trader sees a Forex pair moving sharply in a direction his analysis actually agreed with, but he missed the ideal entry by a few pips while hesitating. Instead of waiting for a pullback or a new setup, he jumps in anyway, chasing the price higher just to avoid the discomfort of missing it completely. The trade reverses almost immediately, taking out his stop before the original move even continues in his intended direction. The lesson is that being right about direction means nothing if your entry was driven by panic instead of your plan. Have you ever watched price move exactly where you wanted, but only after you'd already given up and closed your charts, or worse, only after you'd already entered in a panic and gotten stopped out first? If yes, you're not alone. Almost every trader has lived through the frustration of being directionally correct and still losing money, purely because of timing driven by emotion instead of patience. Let's look briefly at principles from traders who understood this exact trap long before social media and Telegram groups even existed. Jesse Livermore believed that the biggest money was never made by constantly acting, but by waiting patiently for the right moment and having the discipline to do nothing until it arrived. Mark Douglas taught that every single moment in the market presents a new, independent opportunity, completely unconnected to the one you just missed. And treating a missed trade as a personal loss is simply a distortion of reality. Tudor Jones built his entire approach around protecting capital first, understanding that chasing a missed move recklessly puts far more at risk than the potential reward could ever justify. Seykota believed that a trader's urge to chase price is usually less about the market and more about an unresolved emotional need to feel included or validated in that exact moment. Dalio approached every missed opportunity with honest reflection rather than emotional reaction, treating it as information about his own patience rather than a reason to force the next decision. Notice something? None of these traders built their careers by catching every single move. They built them by accepting that missing trades is simply part of the job and protecting themselves from the emotional need to chase what's already gone. Be honest with yourself. How many of your worst trades started with the fear of missing something rather than an actual signal? So how do professionals practically avoid falling into this trap day after day without relying on willpower alone? A trading checklist that requires every condition to be met before entry removes the ability to justify a chase in the heat of the moment. Entry confirmation rules, waiting for a candle to close, waiting for a retest, waiting for volume confirmation, create a built-in pause between seeing a move and acting on it. Fixed risk management, decided in advance, prevents oversized emotional position sizing, even when the urge to make up for a missed trade is strong. A trading journal that specifically tracks why each trade was entered, whether from a real setup or from watching price move without them, creates undeniable self-awareness over time. Daily rules, including a maximum number of trades per day, prevent the kind of overtrading that FOMO thrives on. A missed trade rule, a simple written reminder that says if I missed the entry, I missed the trade, removes the debate entirely before it can even start. And a cooling off rule, a mandatory pause after any emotional trade, whether it wins or loses, prevents one impulsive decision from immediately triggering the next one. If you were my younger brother sitting across from me right now, here's exactly what I'd tell you about this. You chase trades because some part of you believes this exact moment is the only chance you'll ever get, and that belief is simply not true, no matter how convincing it feels in the moment. Professionals don't chase, not because they have superhuman self-control, but because they've genuinely internalized that the market produces new setups constantly, every single day for as long as you're still in the game. The traders who blow accounts aren't usually wrong about direction. They're wrong about timing, entering out of urgency instead of confirmation. And that single difference costs more money over a career than almost any other mistake. Start today by writing down, in plain words, what your actual entry conditions are, and treating anything outside those conditions as automatically disqualified, no matter how good it looks in the moment. Track every single trade you take from now on, and specifically mark whether you took it because your setup was there, or because you were afraid of missing something. Within a few weeks, you'll see clearly how much of your account has quietly been lost to urgency rather than actual analysis. Set a hard limit on how many trades you're allowed to take in a day, because that single rule alone removes a huge percentage of impulsive decisions before they can even happen. And the next time you feel that specific pull to mouse, the one that shows up when a candle is already moving without you, pause and ask yourself one simple question. Am I looking at my setup right now, or am I just looking at everyone else's excitement? Brother, the market doesn't reward the fastest trader. It rewards the trader who knows when not to trade. That single sentence, if you actually let it sink in, will save you more money over your career than any indicator ever will. Asterisk. Somewhere out there tonight, a trader is staring at a green candle exploding higher, convinced this is the one chance he can't afford to miss. And somewhere else, another trader is watching the exact same candle, closing his laptop calmly, reminding himself that the market will still be here tomorrow, and that missing this move costs him nothing at all. One of them will still have a full account next month. The other one will be explaining to himself why this time was somehow different from all the other times he chased and lost. Asterisk. Here's the truth I want to leave you with tonight. The market will always create another opportunity. The real question was never whether you'll get another chance. It's whether you'll still have the discipline left to take it, once you've stopped burning it on the chances that were never actually yours to take. In the next episode, we'll uncover revenge trading, the emotional trap that turns one small, ordinary loss into the kind of disaster that ends trading careers, and almost no one recognizes it happening until their account is already gone.